Supermicro computer stock is down over 26% in the last month, which has investors asking if they should buy this artificial intelligence stock on the dip here. I'm going to answer that question in this video, evaluating the company's financial metrics, including revenue growth, cash flow from operations, and profit margins, and then also comparing that against its valuation, the new valuation with the lower market price. I'm going to look at the forward price to earnings ratio and look at my discounted cash flow valuation of Supermicro computer stock to come to the conclusion and answer if I think this dip is a buying opportunity for long-term investors. Let's get started.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So as I highlighted in the beginning of the video, Supermicro computer stock down 26% in the last month. It's now trading at $32.60. I remember this stock was trading close to $1,200 per share before the split in March around of 2024. That's when I told investors to take profits in this stock. Hopefully you listened to that recommendation and you sold when I mentioned that this valuation was becoming extreme. This was, of course, before the major correction in the stock price, before the short seller report came out, before the company delayed reporting its financial statements, before its auditor resigned and made crucial statements alleging that the management team is not transparent and not honest. Of course, all of that has happened since then, and that's driven the stock price declines to these levels here. All that being said, if you look at the company's revenue, it's absolutely exploding. Revenue growth of over 100% in several consecutive quarters. Trailing 12-month revenue of $15 billion is up almost 4x just from 2022, and management has said that they're approaching $30 billion in annual revenue in a short amount of time. Their revenue is absolutely soaring. Of course, they operate in the most lucrative part of the artificial intelligence market right now, and that is the building and upgrading of data centers that are optimized for artificial intelligence. Supermicro computer also helps with the cooling solutions for these data centers. These data centers, the computing power that's required inside of these data centers generates a lot of heat, and those chips or graphic processing units and systems need to be cooled down. Supermicro computer helps with that and helps to cool those systems at a lower cost. And so that's what's driving this surge in business for Supermicro computer. The operating margins have not been increasing as much as revenue has been increasing. You can see the trailing 12-month operating margin approaching 10% before declining again here in the several recent quarters. The reason for this, management said, is that they're focusing on increasing market share and they're offering their customers attractive terms so that they can make the sale. And they don't want their prospects, their customers, to go to their competitors. And so they're offering these lower margins. But even still, if you look back at the last decade, as I've demonstrated here, this company's operating margin has been low for the better part of the last decade. And if you look at their competitors like Hewlett-Packard Enterprises or Dell, and you look at these particular segments in those businesses, they are also not very profitable either. So this isn't a high profit margin business. Now, the cash flow from operations has turned negative at 16.6%. And I've talked extensively on why this by itself is not a troubling sign. When you have a company that's selling physical products and they're growing revenue rapidly, it's not uncommon to see cash flow turn negative. And it's because they're purchasing inventory and they're building up inventory before they're making the sale and collecting the cash payments from customers. So you have this temporary negative in cash flow from operations. However, in this particular case, it is a risk because the company's financial statements are under question. And so when you have cash flow from operations that are negative and your financial statements are under question, then it brings the whole thing under question because now You could say, are you really generating that kind of revenue? Or is it because the way you're accounting for the revenue that's leading to that kind of growth? Because the cash is not there. So you're generating sales, but the cash is not there. And so is that really a sale? Or are you recording the sale too early? So these questions become more front and center when you have a company with the delays and the resignation of the auditor and all of those other outside troubles, coupled with this fact, does make it into a significant risk. Without those allegations from the auditor, without the delay in the financial statements, without the company's own internal investigations into this issue, a negative cash flow from operations on its own wouldn't necessarily be a red flag. It's just that coupled with the other factors does make this a red flag, a significant red flag for me. All right, let's start to look at valuation. And Supermicro Computer is now trading at its more reasonable valuation. Now I can zoom back here and look at the last 3 years, and you can see the valuation absolutely explode. I had this stock rated as a buy in January. And then around March of 2024, when the valuations reached these explosive levels, these unprecedented levels, I said that was too rich. It was too expensive, that it was time to take profits in Supermicro Computer stock. Of course, I received a lot of heat for that recommendation because Supermicro Computer at that moment in time was very popular, not unlike Palantir or Tesla with extreme valuations. And I've made similar suggestions with those stocks. And of course, because they're so popular, there's a lot of pushback. But the numbers are the numbers, and I'm agnostic to whether or not something is popular or unpopular. I make my evaluation and I come to my conclusion based on the numbers I see and the qualitative factors I've researched about the companies I'm following. So at this moment in time, I told investors to take profits and I downgraded the stock. And it's now back trading at a forward price to earnings of 8.8. This is where it was before it boomed during the AI frenzy of early 2024. So it's trading at a reasonable valuation back to its longer term norm from before that hyped up increase in valuation. Furthermore, if I look at my discounted cash flow valuation model, my intrinsic value per share came to $109 compared to the current market price of $32. So looking at valuation, it looks like the stock is either between fairly valued to undervalued. So then to answer the question, should you buy this stock on the dip? I'm keeping this stock rated as a hold even after this dip, even after this valuation adjustment, namely because of that risk factor I highlighted earlier. That's a big red flag for me. So I'm staying extremely cautious surrounding Supermicro Computer stock until I have more information, until I feel more comfortable about the quality and the transparency of the company's financial statements. Then and only then will I upgrade this stock from its current hold rating.
Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.